So welcome back, everyone. And yeah, I'm delighted to say we have our panel, first and only panel of the day, RFQ versus Exchange, best execution practices and latest innovations. We've got a fantastic lineup for you today. Jason Conan-Davies, Head of Trading at Nutmeg, now JP Morgan. Alex Livingston, Head of Trading for FX and ETFs at Titan Asset Management. Paolo Giuliani, Head of ETFs at Vantage Capital Markets. And Tom Stevens, Global Co-Head of ETF Capital Markets at JP Morgan Asset Management. I think we're missing Paolo, sadly, but we will just crack on. Hopefully he can join in just a moment. Jason, maybe coming to you first, let's sort of dive straight into it. How would you go about defining what best execution with ETFs is?
Good morning, Tom. Thanks for the intro. Well, I think the most obvious definition is obviously price to execute your trades, right? So how much it costs to actually execute and complete your trade. But for us, actually, there are a few or more elements that go into the best execution question. So total cost to settle the trade, for example, that's become a lot more prominent now, with CSDR in play. Any kind of late delivery can actually affect our view of what best execution is for that particular counterparty that we're dealing with. Also, things like speed of execution are quite important as well. There's a lot of automation now that's come about due to the sort of increased volatility since COVID. So that's another thing that we think about when it comes to best execution. So it's a full package, really. It's not just one thing. It's kind of a holistic view of the execution that we do. And we're always kind of assessing this stuff and kind of adjusting accordingly.
Yeah, great stuff. Alex, same question to you. How would you go about defining it, and has this changed over the years?
Yeah, 100%. Good morning. Thanks for having me on. I think coming from where I sit, which is kind of in between kind of trading and portfolio management, one of the big things that we kind of assess is, the individual objective of each and every trade. So, looking at that, speaking to the PMs, and working out what is the specific objective of the trade. Is it the urgency? Is it price impact? How are you, what really is the trade doing? So I think being able to understand the objective of the trade can then help to kind of tailor your best execution, and tailor, how you see, if it's done a good job, of putting that trade on. How it's evolved over the years. I mean, the ETF industry has grown dramatically over the past couple of years. There's still a big focus on sort of RFQ, as I'm sure we'll get into shortly. But it's a very fragmented landscape. Especially in Europe, with all these different exchanges and the broad remit, and offering of ETFs, kind of spoiled for choice. So much so that it means that there's a really wide breadth of liquidity and volume across all of these ETFs. And that's developed really dramatically in the past couple of years with the things like active ETFs coming to the industry. ESG, thematic ETFs. So it's really developed quite dramatically, to be honest, in the past couple of years, and definitely got a couple of interesting years ahead.
Yeah, great stuff. Tom, bringing you in here, maybe a sort of bit of a history lesson about kind of execution practices in Europe. Have they kind of, as I mentioned to Alex, have they changed dramatically in recent years? And kind of, why is it that kind of RFQ trading in particular is such a dominant method of trading at the moment?
Thanks, Tom, and morning, everyone. So, yeah, thank you. You give me the history lesson probably because I might be the oldest or longest in the tooth here, but thanks for that question. So, yeah, I mean, if we look back kind of early mid-2000s when, ETFs launched in the UCITS space, and the ability to trade there was very much kind of voice-driven, your classic kind of brokerage. Then we moved to more of an IB-driven or a message-driven system, or even agency execution was far more prevalent in mid to late 2000s. Then with the advent of some RFQ protocols from a couple of different providers, meant that you were able to put people in competition. You were able to have everything in one place, and later on that meant a little bit more straight-through processing as well. And that was a good thing. The market needed more efficiency there. The ability to trade on exchange was lesser to an extent. It kind of went down a path of more of an RFQ model, but that is changing now. So particularly in the UCITS space, we're seeing more and more algorithmic options. I know we're going to touch on that a little bit later as well, but I definitely think this is the direction of travel now in terms of choice. So I think it's a little less RFQ versus exchange, as a little bit more both. And we just touched on best execution and the different trades that are put in front of Alex and Jason to assess which is the best way to trade. And that's the whole point of best execution, whether that's price, cost, or 8 or so other different elements that JP Morgan Asset Management looks at in order to trade ETFs and other instruments.
Yeah, good stuff. Just following on from that, Jason, have your sort of trading habits developed as well as kind of the markets evolve?
Yeah, I mean, look, I think sort of the ETF space has definitely matured a lot over the years in Europe. We always know that the US is slightly more mature than Europe, and we're always a few steps behind in that space. But we've definitely noticed sort of better execution with larger size on the RFQs. But of course, this means that we have to now be a bit more careful about certain types of trades we do. So trades with less liquid underlyings, we're now using agency a lot more. We're now interacting a lot more with the on exchange liquidity. Whether it's via a broker, because we don't have membership with the LSC, but you can get that via a broker, or whether it's via algos or sort of other means like that. That's kind of ways we're interacting now. And there's technology now getting involved with the industry. So a lot of the contingent switches that we do, where we switch delta neutral underlyings between one asset to another, where there's only a sort of slight deviation in the delta neutrality, we can do a contingent switch on the RFQ now. And that's basically involved a lot of the counterparties interacting with us and actually integrating with the technology to be able to do that with us. So that's another kind of progression we've seen in recent years, and it will only continue, right, as the industry gets more mature, as things get more sophisticated and technology continues to come into the fore. We're going to see more and more evolving of this particular industry that we're in right now.
Yeah, absolutely. And Alex, a lot of sort of buy side people we speak to say, oh, I'm just plugged into an RFQ and just execute all my trades through there. Why may that not be the best approach in all situations?
Well, I think it's good to have a range of abilities to execute via. I think largely why in the European space we've centered towards RFQ is because it's a lot of institutional flow, where perhaps for some of those larger size trades, actually sometimes going RFQ can be a good method to have an instant transfer of risk, and actually it can be quite a good method of execution. But clearly there's no one size fits all. I think Tom's just dropped off there, but there's no one size fits all, and you've got to have a range of methods to access the market. So yeah, and I think, to be honest, issuers, touching on what Jason was saying, I think issuers have done a really good job in educating the market, getting to really understand the liquidity dynamics of how ETFs work. Looking at, for example, screen ADVs, you could be very much understood that you look at a screen ADV of an ETF on Bloomberg or Fringe Icon or whatever, and you actually think it's not that liquid, but then actually looking at the primary underlying market and how much liquidity you can actually access there through tools such as like ETFL, or some of the other sort of pre-trade liquidity and assessments that you can do with other providers, you can actually understand that there's quite a lot more liquidity there than just seen on screen.
Yeah, great stuff. And just a reminder to the audience, we're going to leave a lot of time for questions at the end, so do make sure you get your questions into our speakers. Tom, bringing you in here, maybe kind of the key question for this whole event, but what are kind of some of the keys to achieving best execution with ETFs?
So I think here it's assessing each and every trade on its own merit, and with buy-side dealing desks, appreciate that needs to be done quickly. So being able to have the tools in order to do that needs more technological development. So we've seen from a handful of banks and broker dealers the path they've gone down with ETF fair value algos or ETF algos that have adjusted for mid or small cap implementation shortfall algorithms. It is this ability to be able to assess each and every trade quickly and choose the right venue, whether that be RFQ or trading on exchange with a standard algo or trading on exchange with a more sophisticated ETF specific algo. So I think being able to have that choice, being able to have more than just RFQ, as you pointed out earlier, Tom, is definitely what we see as the demand from different client base. We've held events this year and last year where both Jason and Tom have been in attendance, and they said we just want more choice, the ability to be able to assess each and every ETF trade quickly and in a different way, so that I am delivering best execution is what I want, and that's echoed for another 10 to 15 or so UK buy side dealing desks.
Yeah, good stuff. Paolo, welcome. Well done for managing to get on here. We're just talking about sort of best ETF execution. From your perspective, what would you say are some of the keys to achieving this?
Well, definitely is the key is the instrument, really the instrument, and maybe the time of the day and the urgency of the trade. So the size, so all these aspects, they need to be put all together in order to really achieve, and also the needs of the client, because each client has his own needs. Like in a day like today, the settlement probably is crucial. Today, when you trade US with US underlying or USD currency with the Thanksgiving holiday coming on Thursday and Friday, so the settlement maybe is even more important than the price, because maybe some custodian of some clients, they are not able to settle in USD currency on Thursday, so or they want to have the settlement on Friday. Friday is half day in the US, so maybe you end up having the settlement on Monday with 2 more days of settlement. So really is a completely different scheme from the price. So maybe you have a client that really wants to trade, okay, you want to achieve the best execution, but for them on a day like today, the best execution is having a settlement maybe on Thursday, if you are able to settle on Thursday, or could be even Monday. And with the interest rates that we are having at the moment, so failing on the settlement for 1, 2, and as I said in this example, could be up to 4 days of delay settlement is really, really expensive for clients. So I can tell you that achieving a best price of 0.25 bips will end up with a failing on the settlement, will end up having a big penalty that could be really in the region of several bips just for 4 days of longer settlement. So as I said, the crucial point is not always the price, but also the settlement and the time of the trade. Because if you are able to trade maybe before the cutoff time of a primary order, you can settle before let's say the usual settlement cycle. Otherwise, you end up having a later settlement on the trade.
Yeah, great stuff. And yeah, Tom, do you want to jump in there?
Yeah, I think Paolo is absolutely right, and it kind of plays back into some of the things we talk about trading on exchange. So there is there's an opportunity cost by not looking for or assessing some of the liquidity on exchange before deciding to trade on an RFQ. But that's where all buyers and sellers, the natural definition of an exchange or a stock exchange is where people go to buy and sell shares, stock, ETFs. So being able to have that kind of en masse approach instead of more of a bilateral or one to many different brokers using the RFQ, you have an ability to be able to meet other buyers, other sellers on exchange, and that can help mitigate some of the settlement costs or settlement risks for netting and clearing that we should be taking advantage of as buy-side ETF practitioners.
Yeah, good stuff. And Tom, just following on from Paolo's point around settlement, what about the impact of kind of T+1? What is that throwing a bit of a sort of spanner in the works slightly in terms of settlement? What's your take on that move?
So for the markets for US, Canada, Mexico next year, they're going to be doing that in May 2024. All ETF issuers, all buy-side participants are getting ready for that, whether it's mutual funds or ETFs, and the underlying trades that we have to do. So I think there's a lot of working groups, there's a lot of internal talks between many different elements of our manco and our structure to make sure that we mitigate this, that this is not going to be affecting tracking error or active performance in any of our ETFs. So it's still a work in progress, but I think there's extensive both internal and industry work going into this. Again, not to labor the point too much, but if we look at both the US and Canada and Mexico going to T1, and then what we might be doing with regards to Europe and the UK with T+1. Stock trading on exchange can help mitigate that. If everybody was there and trading T+1 in that respect, then that you're going to be trading T+1 against somebody else, right? So you need to be able to look at that and assess that for what it is.
Yeah, great stuff. Jason, what's your take on that question around kind of best execution? What are the kind of keys from your perspective?
Yeah, so the question you asked about sort of how best to get that best execution is one that rings kind of sort of really relevant to us, So essentially, engagement with all the stakeholders within the ETF ecosystem is really important, right? So we have to work together. I think Tom mentioned this earlier, but we work with issuers to sort of plan any large moves that we may make in the future. We work with counterparties, obviously, because we're trying to get best execution in terms of price with them. And so sometimes we'll be looking for indications of pricing on certain trades that we want to do, obviously not giving too much away. We even work with other buy-side constituents at events like this and other similar events where we discuss kind of our experiences with different issues within the industry, and then obviously we even work with a lot of the trading venues, so the LSE, the Bloomberg, the Tradeweb, multilateral trading facilities such as those. We've worked closely with a lot of these guys to build new technology and actually test stuff and suggest things that have actually then been released. So the whole ecosystem needs every single constituent, every single stakeholder within that ecosystem for the thing to work. So yeah, I'd definitely say my take would be engagement with other stakeholders within the ecosystem is the best way of getting that best execution.
Yeah, good stuff. And Alex, sort of same question to you, but sort of breaking it down a little bit about when should traders when should you execute at risk, via an RFQ? When should you go NAV, agency? What are the different approaches you have? When should you execute all those different sort of trades?
Well, I think you should certainly be aware of all of them, be able to have all those sort of arrows in your quiver and be prepared to use them. I think especially risk is excellent because it's an instantaneous transfer of risk, getting off your balance sheet. But with that, NAV, clearly you're getting the end of day NAV, or it might even be T1 NAV. So effectively you're willing to take on that the market moves, but you'll be perhaps be sort of getting a tighter price to sort of mid or NAV than sort of risk. And then finally, there's also sort of agency coming into it as well. So for those larger trades where you've got really big risk of sort of information leakage, those agencies can really help at sort of intermediating that risk and you're sort of minimizing market impact. But again, you've got to be working with the specific objective for each trade. No, you shouldn't have a sort of one size fit all policy. You've got to assess every trade on its individual basis and work out which way is the correct way to market for each trade.
Yeah, good stuff. Paolo, same question to you. When should traders look at all these different options?
Well, it depends on the underlying and really the urgency of the trade, I would say. On the equity space, in terms of asset classes, usually risk is the one of the main say avenue used. On the other side, with the NAV trading, you can offset the risk. So you have really on similar ETFs, you are able to buy and sell and matching the two different, two or even more different exposures. So you can have a European sector hedging with another European sector. With all the stamp duty involved, you are able to offset the risk and having, let's say, maybe a basket to execute in the market with less number of components, because you are really offsetting the risk, because we have maybe quite similar or even the same components. The same is also if you trade European ETFs versus US listed, or maybe even Asian listed ETFs. With the NAV trading, you are able to really offset those two risks, and so you are netting the two activity. On the algo, definitely you are having a different behavior. So that is really what the ETF is aiming to achieve, moving away, looking more to an equity trading instrument like the ETF were supposed to be at the beginning of their launch.
Yeah, good stuff. Jason, did you want to mention something there on that point?
Yeah, thank you, Tom. Yeah, obviously, as a buy-side institution, we often have to make this choice of how we execute. So I think Paolo said it right about, depending on sort of time you have, and urgency is quite an important one. So obviously risk is the go-to way to execute at the moment, sort of OTC for ETFs. But yeah, we also can, as I mentioned earlier, if we've got a sort of slightly more delicate trade with sort of more liquid underlyings, and we don't want to disrupt the kind of spread and push up those offers and push down those bids, then we will maybe work agency, to split the trade up, either trade weighted average pricing or volume weighted average pricing, and just execute via an algo, sort of assess getting that on exchange liquidity. With NAV trading, we've actually found we prefer to use it when we're actually switching from one asset to another, where the underlyings are quite similar. And the reason for that is because obviously there's a long time from when the NAV is sent to when the actual price is struck in the closing auctions, and the following day when it's actually printed. And we also have to consider things like, for example, is the underlying Far East underlying? If it's Far East underlying, then it might take 2 days for us to get that NAV, and therefore there's a long lead time between when we're actually sending that trade and when we actually execute, and that may disrupt kind of what we anticipate we're going to actually be spending on the trade. So it's about engagement, not only with other sort of stakeholders, but with the actual trade itself, doing your research, looking into exactly what your trade consists of, and then making the decision off the back of that, and then retrospectively assessing what you've done so you can improve the next time.
Yeah, good stuff. And Tom, do you need to take a different approach depending on the asset class? What's your thoughts on that one?
I don't think so. I think you're assessing each trade, therefore assessing each asset class as to its underlying liquidity, as Paolo and Jason and Alex have pointed out. I think the crucial part, as these gentlemen have already said, is the impact, the urgency, of what you're trying to achieve. So whether that's gold, which has hyper liquid spot and futures market, and on the many ETFs that trade billions of dollars a day on exchange for certain ETCs and ETPs, then algorithmic trading can be used there, risk trading can be used there, because there is the ability to access all of this liquidity. If you're trading something a little bit more esoteric or a little bit harder to do, let's say a single country EM, then you might not have the ability to trade the underlying there and then. You might not have the ability to trade the ETF on exchanges in the size that you want. So therefore, a risk trade for what you're trying to achieve, if you've got the urgency there, might be the way forward. So I think it's kind of yes and no. You're assessing each trade, therefore you are assessing each asset class.
Yeah, good stuff. And you mentioned ETF algos there. How much of a kind of positive impact have they had on the European ETF market specifically, and how are they kind of helping buy-side traders achieve that best X?
Well, I think we're at the early stages here of development. We mentioned earlier 4 or 5 different banks and broker dealers that are developing different ways to assess ETF liquidity via algorithmic desks or low-touch desks. I think it's definitely the direction of travel and the future for where ETFs need to trade a little bit more, well, a lot more, to be honest, on exchange, and to kind of level up the ability to do so across lots of different asset classes and different ETFs. So I think with that, we have to encourage the exchanges to do more. We have to encourage our banks and broker dealers to do more, to develop more, to spend those technology resources in order to be able to offer a more complete package. And the exchange is the same. When we look into the market maker side, those that are providing liquidity on exchange, what are those data costs? What are the clearing and settlement costs? How many messages per second can they send before they get charged more, or is it a complete bundle? Therefore, we can encourage more people to come to the stock exchange and trade there. There's a number of firms that are waiting to see and waiting to make sure that the European market goes in a similar direction to the US.
And Alex, same question to you. Is this some ETF algo something you're sort of increasingly starting to use more?
I think, to be honest, I kind of echo Tom in saying that it's kind of early days. I think people are still kind of feeling out, who's got kind of, which algos work best, depending on, the asset class, and depending on, urgency, all the rest of these, matters that we've already kind of discussed. So it is still very much early days. I think there still has to be quite a lot of, volume driven onto the exchange. So I think in the UK, especially, we need to do a bit more in terms of, trying to get a bit more retail flow. So, for example, with the platforms enabling sort of, fractionalized dealing, we'll perhaps start to get some of the movement there. Because as I said, it is very much controlled at the moment by those sort of larger institutions sort of dealing. But I think in time, we can kind of get to a point where, perhaps there'll be a lot more volume on exchange, and some of those algos will work really efficiently and bring a huge amount of efficiency to the sort of ETF ecosystem.
Yeah, good stuff. And we've got one more question before we sort of open up to questions I want to ask. Paolo, maybe to you. Obviously, you don't see as much kind of RFQ trading in the equity market. Do you think the ETF market will eventually shift to look more like the equity market over the next few years, or what's your take on that outlook?
Well, my take is, if I may, if I have a few seconds to talk about really in a historical way, because the point is really ETF at the beginning, they were just listed on local exchanges, on specific local indices. So the FTSE in London, the DAX in Germany, the CAC in France, the SMI in Switzerland, the MIB in Italy. Then we had really 3 big waves of really changes. First, the cross-listing of the ETF in all different exchanges. So the same ETF really with the same ISIN listed maybe in different currency, but in different exchanges. Then that is quite peculiar for the European market. The index provider, and this is really a crucial point, index provider really started to grant the index license to really a huge number of ETF issuer, up to 10 or even more ETF issuer for the same index. So really creating the fragmentation that we have in Europe. So we need to understand this in order to understand why the RFQ platform have such a big success in Europe versus the US. And the third point, before coming to really to direct answer, is really the fact that the market maker really have and they still have a finite resources in terms of capital to provided the quote in the different local exchanges. So at the end, the buy side, the client, if they want really to have a big block or liquidity on one ETF, they really embrace they plugged into the RFQ platform. So this is really the crucial point. The last one is really the lack of consolidated post-trade reporting, because at the end this really also doesn't help to mitigate the fragmentation that is specific of the European market.
Yeah, good stuff, Paolo. We've got time for one question, and it would be remiss not to talk about pre-hedging. So we have had someone come in from the audience. Jason, maybe one for you. How much of an issue is pre-hedging by liquidity providers in RFQ bids? Pretty straightforward question.
Well, to be honest, I guess you have to take care of every single trade you do. So obviously with the less liquid, more sensitive stocks, larger trades that we do, we show a smaller population of counterparties. But even with some of the preparation work we do for our normal trades, we'll make sure that there's not too much information being leaked out to the market. We always send our trades two-way as well, so that there isn't kind of any direction given to the trades we're sending out. And I think it's just a general sense of being cautious, being careful, being aware that, give out too much information, people can act upon it. So I guess nothing changes for us, really. We just continue to operate in a way that allows us to be sensible and allows us to sort of keep our cards close to our chest, while at the same time, getting the information that we need if we need to kind of do any preparation.
Yeah, great stuff. That's a good point to end on. Sadly, that's all we have time for, but I want to say a massive thank you to our 4 panelists here today for sharing their insights. I do really appreciate that.